Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel for our final live edition class today. It is Building a Stock Portfolio, and I'm your host, Kevin Horner. Thanks for being here, everybody. I'm joining you from our Denver studios. Pleased today to be joined by my friend and fellow Schwab coach there, Connie Hill, in the chat. Connie, of course, available to get to comments and questions. I'm unable to, but as always, I'll try and keep a close eye on things. What's going on in the chat, probably bring your desires and conversational topics to the conversation today as well. We do need to place some new example trades for our example portfolio. We took a couple of shots last week, some positions we've migrated out of due to stop orders and so forth. So we're going to get to a look at the example portfolio. We're going to place a couple of new example trades, and we are going to manage the ones we're already in as well. So basically, the same class we try to provide for you every Taco Tuesday, as I'm nicely reminded by all of you in the chat. Hey, Ricebird. Hello, Will. Good to see you, Jay Richardson, Rita. Always love seeing the same names come to these classes, so thanks for being here today, everybody. If you're not already doing so, you are able to follow me and Connie on X, Connie Hill CS, and Kevin Horner CS. It's a good spot to find us when we're not offering you classes here on the channel. Posted a bunch of notable charts today as I'm trying to get back in the saddle. So if you're looking for equity charts and the like, that's what you're going to get from me as consistently as I can. So follow me there. Now, let's go ahead and get to our disclosures, and then we'll dive on in to the discussion today. So please remember that everything we cover should be considered informational and educational only. We do not make recommendations nor any endorsement for a specific approach to trading. What we will offer today are some concepts and strategies of technical analysis and trade management that traders may choose to employ, but it's important that you customize any of these to your own liking, your own tolerance for risk, and your own comfort for trading the market. So please bear all that in mind. Additionally, it's important to know that we work in a paper money version of the desktop Thinkorswim platform. That does mean that in some instances, your executions will differ than the norm. In our scenarios of trading for individual stock like we do in this class, not a whole lot of discrepancies, but we do not place after hours trades here. We place trades for the following day as opposed to after hours or pre-market. So everything we do will be based on a regular session beginning tomorrow morning. Now, what we like to do here in this conversation is get started with a fairly quick review of the broad market at the close, and I'm going to do that for you. As you can see, we finished in the S&P today with a bit of a pullback off almost two-thirds or a little more than two-thirds of 1%. We broke the 10-day moving average today on our open, so some would say with conviction. You can see that we tried to get a little bounce early, and then that did not hold. So what we've got is a potential pullback underway. The 20-day moving average beneath us, catching up with our horizontal support at 76.20. That was the prior high back here in early June. So as usual, a technical analysis 101 concept available to us. Breakout for about 2 weeks. Look for a throwback to test the breakout level, and that's kind of what we're hoping provides support for us over the next couple of days. Might be the 20 period and the horizontal support in the vicinity of 7,600 up to 7,620. So that bears watching for us here on the SPX. Now in the NDX, things were a little bit more negative, as you can see. We are still above our 50-day moving average, and I'm going to clean up some of these lines for you. But this line here, this level, is one worth monitoring, isn't it? Basically the gap ledge from 2 weeks ago, and we tested it very quickly 2 days later and have held since. Now the 20 days catching up to that. So could it be the 50-day offering support? Sure. Could it be the 20-day? It could. We could even fill the gap, which is what I eliminated with the rectangle. But, this also is a possibility. We could find ourselves intraday at any point into this zone. Now, of course, if we break below the rectangle, things decidedly shift here, right? So we don't necessarily want to be believers that it's all rosy from here. I mean, down days are difficult for us, of course, but a shift to below the 20-day or below the gap high here would be a fairly negative development. That's what we don't want to see. Of course, that doesn't mean we couldn't see it. It's certainly a possibility, but we got to keep on kind of on our toes to that extent. We don't mind that we're pulling back a little bit because we have broken out. The fact that we've held everything since the breakout on August 4 keeps us optimistic, but we might need some more time to shake out. And you'll also notice down below, the RSI got into a lower level, right? Kind of got at the upper edge. It was about 60 into the RSI, but that's still a lower level. So we've kind of seen some bearish momentum detail from the RSI. We'd like to see that shift. Let's look at our small caps, which gave back quite a bit today. 1.3% looks to me to be a pullback of deeper proportions in small caps that have been moving. Heck, we just made new all-time highs 2 days ago, so we're not going to overdo it here. But reminder that when we get these pullbacks, we should at least expect something in the vicinity of the 50-day moving average. We have been above it since April 8, way back here, and we've only been below it for, I guess, 2 out of 3 days right here, and that was it. So 50 days, certainly an area that traders will be monitoring that comes in around 29.75. So let's hope we don't get there, or thinking about it from a standpoint of momentum and sentiment, the kind of thing that could happen, of course, could be the open that is weak and leaves us at the 20-day, or pardon me, at the 50-day from an opening standpoint, which would be a pretty aggressive gap lower. But if we opened at the 50-day and then rallied off of it, that would tell us quite a bit about the sentiment and the opportunity for subsequent momentum. So we don't mind weak opens if they're followed by strong closes. And that's kind of a reminder about the health of a market. In today's case, oil was up a bit, and we saw a kind of a selling of the broader market conditions across the board for much of the day, and there really was limited bounce. So not a lot to take from that, unfortunately. Okay, let us talk about the example portfolio. I'm going to go ahead and close up this watch list. We're going to jump to my monitor page here, and we're going to next go to the account statement. There's been a couple of trades that have gone off in the last week. So let us change this to 7 days back so that we can just revisit what we've done over the last week exclusively. Get that to no symbol. So this is going to show me all of my execution. So last week we made purchase of OKE, of PGR, and PCAR. Unfortunately, as you can see, we got PGR got stopped out on us. Cisco, we put on a position 2 weeks ago. We did that first triggers 2 OCO brackets. One of those brackets executed. We will look at Cisco, but we should also check in on PGR. So quickly, let's do PGR just so that we can see what occurred here. We had a desire to be a buyer based on the 200 period moving average. So we were buyers at 209.73. We were trying to be holding basically the prior day close, which was on the 200. Well, then the very next day we opened weekly, and then we actually held it for all of about 3 days before we made a lower low. Now, as you can see, this is pretty good, interesting spot for support in here. But nonetheless, we got stopped out. Our loss was very limited in this case, everybody. We were looking for a quick bounce. It did not occur, so we lost all of about 4.5 points on a 25 share position. So really not a whole lot, about $100. And again, the reminder is that we need to try and stay to our preferences as much as we can. And that consistency is what will reward us over time. So for those of you who are perhaps new here, the important thing that we have is a risk factor not to exceed $1,000 on any one trade, and our position size should not exceed $10,000 on any one position. So we're going to balance those two calculations every time we place an order. This was a fairly small position. Of course, 25 shares means about $5,000 invested to lose only 100 and plus or so. That totally fits within our tolerance. This could get back into a trade opportunity in the future, but at the moment, we are below all three of the major moving averages, which is one of our key factors when picking new example trades. So unfortunately, Progressive will not be on the list for today. Now, go back to that monitor page. Let's talk about the Cisco position. Cisco, like I mentioned, we did we did a entrance for 100 shares, and then we set two separate brackets. So we now have only one bracket on. We have a stop for the remaining 50 shares. So again, we bought 121. We got stopped out on 50 of them at 114.47, and we've got the remaining 50 at an 1 ATR, average true range, below the let's see here. I think it was below the 50-day moving average. Our ATR is about $4, and we are in at 106.94. So really, yeah, we are kind of we're in a precarious spot here, aren't we, everybody? Obviously, one thing we're not going to do in our case today is we're not going to make an adjustment to the Cisco sell stop because we've done all the work on this one. We have the order in, and we only adjust our stops to the upside. We don't adjust our stops to the downside. So therefore, there's no point in making an adjustment to this one right now. Obviously, we are sitting on support. And then I know this is going to sound kind of it may come off a little flippant, but I'll just remind you, our goal is not to be sellers at support. We want to sell when support breaks. And that's why our stop is below support. And that's us using average true range to get below that number by the calculation of the last 3 weeks approximate low to high average trade day. So, we are not going to cut this number down. We're not going to move the stop lower. We're just going to hold steady in the belief that support will maintain and we'll see upward momentum from here. So no adjustments to the remaining Cisco shares. Okay, we did also put on a position in PCAR and OKE, and then we did get stopped on ROP. So let's jump back to the actual activity and positions. Now you can see, let's see. Oh, I know what we did. I'm sorry, everybody. We did not get stopped. I made an adjustment to the ROP. Let's talk about that. The ROP position, I had made an erroneous trade. We made 100 share purchase when we intended to make a 10 share purchase. And so last week we made the adjustment. We bought in 100 at 394.47. And last week, upon realizing that error, we went ahead and liquidated 90 shares so that we could put ourselves in the proper position. Now we have that stop here. Today that comes in at 365.71. So we are 1 ATR below the 200-day moving average. So the 200-day moving average is actually downward sloping, unfortunately. So if I was to do some math on the 200-day at 378.13 and then reduce that by the amount of our current ATR of 1133, our stop would be at 366 and 80 cents. So we could move it up a little bit here if we wanted, everyone. We could pump that from the 365 and change to 366 and change. For our purposes, I'm going to leave this be. The difference of $1 and change is all of $12 or something like that. That's not a good enough reason to me to alter the stop that we've placed. I want to give this one a little bit more time. But I will point out the action here, since we've been talking about it, we have held the 200-day. We've also held the 20-day. Now, what we've learned is that the 20-day has been commonly violated and taking us out consistently. But nonetheless, it's above it. Let's see if it continues. So we're going to keep our stop on ROP where it's at. Okay, next up, Let us talk about that OKE, which is already going in our favor. So we'll look at OKE briefly. We've got a 50 share position that broke to the upside. Now, this is a little different, everybody. We've been in this one a little bit, as you can see, in here for a profit, in and out here for a small profit, that is, in and out here for a small loss. And now we're in at 91.15 for our 50 shares. But I want to point this out. We built this based on the weekly chart, everybody. We were working with the 50-week moving average. Let me put that in there. 81.82 today. And our stop is the weekly average true range below the 50-day. So that's about $6. So that would put our stop somewhere in the neighborhood of about 85.82. Currently, we are 75.82, excuse me. We're at 75.22. Again, trying to give this as much time as possible. We're going to keep the current stop on this, but I will point out this is a very improving chart at this moment. We can also point to the fact that we're breaking out of a range here. It's basically 82 to 95, about 13 points. And if you add that 13 points to the $95 breakout, we end up somewhere in the neighborhood of 108. And that's not terrible. You know, that's going to look like it's up here at the last peak approximately. So we appear to have a little bit of an upside move here in ONEOK, and we'll see if that rolls. But it's broke out today, and we just need to kind of manage ourselves by not taking too many actions here on the first day of a breakout. So let's see if this can get running and get into gear. If it were going to get going quickly, then maybe the 10-day moving average would catch up and provide short-run support. But this is a lovely development, having moved to new short-term highs through 95 on ONEOK. But again, no changes to the ONEOK position at this time. Let's look at PCAR, PCAR. There we go. Now we did just get this one. Now we are already in danger a little bit, aren't we, everybody? 127.22. We are working against the 20-day. Now, just a moment ago, I said we've learned that the 20 days have not been holding up as well as we would have hoped, even though we're catching the 20-day providing support. And then all of a sudden, when we find our opportunities, we're getting in and getting stopped out. And I think what we're learning is it's important to maybe, instead of working with that 20 period, we might be better suited to stick with the longer, more intermediate term 50-day simple moving average. Now, of course, we're not going to make an adjustment to our existing situation. We're going to let this one go in the hopes that we get a bounce here quickly. But ultimately, we may have been better suited, even though we were above the 20-day from June 2 all the way through 8/11. You were basically looking at 2.5 months holding the 20-day. Well, the last week, that's changed on us. Now, does that break the trend? No, it maybe breaks the short-term trend. The stock, however, breaking through that white line 3 weeks ago, that was really the significant development. And then you'll notice down below, look at how big the volume was when that occurred. So that validates the breakout. Let's lean more into the breakout and then the subsequent pullback in a belief that the pullback is necessary, right? Very common. You get the breakout, you'll find the pullback, and that pullback validates support. We would love to see that pullback have held the white line. We're under it at the close, but there's nothing to suggest that we couldn't be right back above it tomorrow. Also, nothing to suggest that we could not maybe test the 50-day before bouncing. We don't know for sure. But today I'm feeling a little disappointed that we didn't use the 50-day. But again, we're not going to reduce that stop level. We've got the proper amount of risk for our trade. We're going to stick with it. Okay. Then we've got some of these winners that have been doing well for us. Let's talk about Dollar Tree. Dollar Tree continues to run. We're up about 1,500 on a position here. Let's look at the chart. So we've still got that sell limit up there, everybody. We're in at 135. We haven't gotten there yet. Now, our stop, we have raised a little bit here and there. The trend, as you can see, is up in the orange line, so we know that we could raise the stop. So let's look at what the number would be there, everybody. 127.58 at the close, and our ATR today is 313. So if we went with 313, then we could have a stop at 124.45, and we are currently at 121.27. This looks like an ample adjustment to make. So let's push this up by that amount, by about 3 points. But again, my math at 124.45, we don't like that 5. So we're just going to go up to about 124.38 or so. And again, here, everybody, I'm just clicking and dragging. There we go. What is that? 124.29. Let's go just a little bit higher. So I'm just clicking edit to adjust that, everyone. And then we're going to go up to about 37. So 124.37 is a measure of the ATR below the prevailing moving average. In this case, that 20-day. However, well, let's go back. Hang on a sec, everybody. I just got done saying I don't like that 20 days. So let's see. 122.56. And see, that would keep us at, yeah. Okay, I'm going to solicit some feedback here, everybody. How about you all help me out? What do you think about the Dollar Tree? Okay, we do have the limit out there, right? We have a good chance of getting to our limit at 135. Heck, today's high was 133.45. So we've got as good a shot to get executed at our trade limit tomorrow as we do getting stopped out. The question is whether you want to stick with the 20-day where we've done the math and keep the 75 share stop order where it is, or do we raise the stop? Of course, if we raise the stop, we're increasing our risk, which is increasing our risk of being stopped out. We are working to make a greater opportunity. We have a greater opportunity to capitalize and take our profits by raising the stop. But if we keep it on, hey, we don't even have to visit the 50-day here. So I would love to hear what you all would do here. Given that we've learned 50 days are a little bit better than the 20s have been to us, at least in this class. So tell me what you think, everybody. If we stick with the 20-day, I'd say we could make the adjustment, but I'm actually leaning towards just kind of holding status quo here to give us the chance to stay with it a little longer so that we have a better shot of getting taken out at our limit. Obviously, the last thing I want to do is get stopped out, 8 points lower or 8 points lower, but that's kind of where we are. So I'll let y'all think about that. If you want to put it in your thoughts here, that would help me out a little bit. So what I would also like to do is go back to that zebra trade, which has also been working out. So let me explain that. Yeah, Shri, you see the title is Building Stock Portfolio, but the trading plan shows buys and sells. Building the portfolio means analyzing company fundamentals and investing for long-term to build. You're not wrong. This is not an investor class, however. This is a trader class. So if you wish to be an investor, you absolutely should incorporate those fundamentals to building your longer-term hold plan and process. What we're working for here is to incorporate the technicals, and we are building the positions based on the technicals. The technicals we're adhering to are buying stocks that are in uptrends in 3 time frames: above a 20-day, above a 50-day, above a 200-day simple moving average. We are not concerned beyond that. When we are building out new example trades, it is commonly based on the leading sectors at the time. So today, when we build new example trades, we'll be doing so in healthcare because healthcare closed at a new short-term and actual all-time high. So we will absolutely explore healthcare today, but we will not dive into any balance sheets. We're not going to be looking at fundamentals. What we are writing is the current trend and talking trend management and trade management more so than building an investment portfolio to hold in perpetuity if possible. That's not the plan here. So just wanted to make sure that we addressed that. Okay, Rita likes staying with the 20-day. Lori, keeping what we got. Bryceburg, Jay, everybody seems to be comfy with sticking with what we've got there on the Dollar Tree. So guess what? We'll do just that. Let's see if we get lucky and get taken out, though, this week. We got a good shot of getting to that 135 limit on Dollar Tree. So on the zebra trade, let's look at what's going on here. Let's going to zoom in a little bit. We did a 20 share purchase back here, 263.14. The stock rallied aggressively for us. We took 5 shares off, and then we placed a stop that is 1 ATR under the 10-day simple moving average. So our stop today was at 357.64. Today's low, 358.68. So the low missed it by about $1. We are absolutely at risk of being stopped out tomorrow on 10 shares. But as you can see, we've got our ditch out point for the remainder at 313. So that means that if we happen to get stopped out on the 5 shares, let's say we get stopped out on the 10 at some point this week, and then we've got those 5 shares eventually we get stopped out at 313, we're still looking at a $50 per share profit on those 5 shares if the stop order executes at our trigger price, which there's no guarantee of course. But we've done a decent job of managing this trade. Now that it's under the 10-day moving average, for some of you traders, you'd be moving on already. A close below the 10-day in an explosive move to the upside could be viewed as the necessary pause. Now, just because a trader sells on a close under the 10-day doesn't mean they're not waiting to get back in at a lower rate, a lower level. They absolutely might be. Maybe it's the gap level down here, right? The ledge at around 330 could prove to be opportunity. But because of what we've done to manage our trade, selling, we did sell 5 up there at 367 from 263. So 5 shares got $100+ of profit. If we get executed on these ones at our stop, it's going to be about $90 of profit approximately. So a good managed process here that has us exiting little bits and pieces of our trade as the run can continue. All right, so that's where we stand on our existing positions. A little bit surprising, but we're not going to make any adjustments to the existing portfolio's exit strategies today. And we've got good reasons behind that for the time being. Let's just hopefully next week, instead of the 5 shares, our 5 positions, we've got a few more to manage. So let's take a look at our uptrending all time frames. Healthcare, which is I'm pulling from my personal list, which I've titled Uptrending Healthcare All Time Frames. And for those of you who are here for perhaps the first time, I will show you how this looks just to give you a quick visual. So essentially, this is what I'm using. And all we're looking for, stocks in the S&P 500, you don't even need the average volume in this case, everybody. If it's part of the S&P, you're going to get adequate volume to be in and out of your positions most likely. But we're just looking for stocks in the S&P, specifically in healthcare, that are closing above their 20, closing above their 50, closing above their 200. That tells us we've got stocks in 3 different time frames that are trading in uptrends, okay? And that's what we're looking for, because that also tells us that there are traders in 3 different time frames who believe that these stocks are in uptrends. And that can give us something to work with. So as we navigate, let's go to Eli Lilly. Eli Lilly had a good day today, up 3.5%. Pretty interesting here, right? First of all, we had a good trade back in the day. We bought 5 shares back here and sold them as they got into resistance. We did not reestablish. We surely could have, couldn't we, on this pullback here to the breakout spot. And then the same thing right here at the breakout spot. But today, if I put all the moving averages back up, there's the 1173 as the 50-day moving average, and we are dabbling with a potential breakout. Now, for a lot of traders here, you would look at this and say, all right, a close, this is the highest we've seen it. Obviously, we've had a high here that got up to 1249.45. But some traders would just be a buyer on a break of about 1240. That could possibly be a buy stop order where the trader says, I'm willing to wait until it starts to move through resistance, and then I want to be a buyer, willing to forego the difference in price. So tomorrow, if we opened at 1225, the buyer would on a buy stop would say, no, I'm just going to wait until it actually breaks that upside red line, the resistance at 1235. Maybe I want to see trade at $5 above that, or maybe 1% above it, which would be $12 above it, right? So that could be a way to think about it. In our case, when I'm looking at this pattern, everybody, the thing that just stands out to me, and by the way, I should point out that this is not just in Eli Lilly. Look at what healthcare looks like. Oops, there it is. Healthcare looks tremendous here, doesn't it? I mean, that's a new high close. You've had a series of bull flags that have been broken to the upside, right? So it's basically a lot of the same stuff. If I put that 20 period moving average back on, bouts below the 20-day have been your shot to participate. So you've got a collective space that is quite bullish at this point. Of course, that'll shift at some time, but for the time being, we're seeing leadership and strength out of healthcare. And so when we look at Eli Lilly, if you're thinking about this from a standpoint of, is it more likely to break out than to hang out in this range? I think bullish traders are feeling pretty optimistic on a breakout here. Now, that means to me, we could be buyers anytime tomorrow. So we could put in a limit that just says anything under 1235, right? Gives us a little bit of wiggle. Anything under 1235 puts us into the position. And then we go one average true range below the 50-day moving average. And that seems to make sense to me. But the math on that could be a little tricky, a little difficult, because it's going to be a big spread, right? So let's do the math. If we go with 1172.58 less our average true range, which is 45.28, then we have an exit strategy. Oops, I got that backwards. Excuse me, everybody. 1 second. 1172.58 less our ATR 45.28 puts us at 1127.30. Okay, so that basically means we're risking about $100 a share. Now, for our comfort, we surely can't own 10 shares, right? Because 10 shares would be a $12,000 position. 5 shares would be about a $6,000 position. And 5 shares risking a little more than 100 would be about $500 per share or per trade. So we could absolutely make 5 shares work within our tolerance process. So that's what we will do here. We will place the buy. And I hope what you're seeing here, everybody, is coming through. I am admittedly not going to the letter on the absolute letter, if you will, on building the trade. I'm kind of massaging it sufficiently such that I can go from 10 shares down to 5, and I quickly can see that I can make that trade work, risking 100 plus, but not risking 200, right? If I was owning 5 shares and risking 200, well, now I'm at my $1,000 max. Anything under that should be good wiggle room for me. So we're going to go with a limit to buy as long as it's under 1235 tomorrow. We'll put a stop 1 ATR beneath the 1173, which will put us in at around 1127 approximately. And then if it breaks out, terrific, we'll be participating, and we'll, if we want, in fact, you tell me, should we set a limit on this? Could we use the range that we're really trading in? It's 11, let's call it 1115 up to 1235, which would be 120 points. Should we target 1350 for our sell target? We can absolutely do that as well. So let's try that. If you guys are game for such a trade, we'll do a buy limit with brackets above and below for protection. So above for an exit strategy and below for protective purposes. So we'll go in here with a right click, buy custom with bracket. And let me close this to give us more space. We'll do 5 shares. There we go. Okay. Limit for tomorrow will be up to 1235. And remember, This is a limit. So when we say 1235, it's this price or lower. So as long as we get any opportunity tomorrow under 1235, we're going to buy the 5 shares. So then we will set our subsequent limit at 1350, good till canceled. And then our stop will be 1120. Well, it says 1127.30, but we're going to do 1126 and then an odd calculation of some sort. So I'm trying to come beneath it, but just by $1, which isn't going to be a whole lot of wiggle room, but some wiggle room make that one good till canceled as well. So buying at 1235, subsequent sell limit about 115 up, or at 1126.33 on a stop. Remember that stop price does not guarantee execution at that price. Even if it triggers at 1126, we could get executed at any price thereafter. Please bear that in mind. All right, there we are on Lilly. Guys, I found a couple more though in here. It's not just Lilly. I was also looking at Johnson & Johnson dabbling with a breakout here as well. For those of you traders, I mean, looking at basically these charts look so similar, don't they? You got the 50-day, beautiful. You broke the 50-day here, whoop, and then right back to it for a test, right? So we tested and held, continued higher. Now you've got the 50-day right here. So this could be a good spot for some example trades as well. 1 ATR beneath the 50-day moving average. So 579 from 252.76. Not terrible, right? And then again, maybe this one is a buy stop instead. We could totally do that. So let's just to illustrate the process, let's do it. Let's take the highs. My line is drawn in at 270.47. And by the way, if you're ever wanting to cheat, you can always make sure you've got your high-low bubbles added here. This tells you the high trade in the chart that you're looking at. So we could say 274.90. And some traders, you guys like to do buy stops when it's validated as a breakout. So one thought might be that you want to break out by one of two measures. Some traders would say, I want 3 days above the breakout level, 3 consecutive closes over 271, for example. I call this the rule of 3. So it's either 3 consecutive closes over 271 gives a trader reason to break through and buy, or a 3% intraday or at any time violation of 271. So if you wanted to use the 3% violation of 271, we would do 271 times 1.03, and that gives us 279. Now that's a lot to give up, admittedly. Okay, so not everybody is going to be a willing buyer 8 points above the breakout. Okay, but that's one way to think about it. And I just wanted to give you all another calculation and concept to work with. For our purposes, instead of 279, instead of 3%, let's do 1%. Okay, so 271 times 1.01 is 273.71. That's our buy stop. Remember, triggers at the amount we set becomes a market order to purchase thereafter. So we will be a buyer with a bracket at a stop for tomorrow, 273.71. And then let's see here. So the range is 247 to 271, so 24 points. So let's target 295 to the upside. Okay. So we'll do a 295 good till canceled target for 20 points, approximately, if we get there. And then our risk, so our entrance is 273.71, but our stop at 252.76 minus the average true range of $5.80 puts our exit strategy at 246.96. Okay, so I'm going to mark that in for the stop. All right, now last bit of math. If we get into the position at our stop price exactly, which again is not guaranteed, then our risk from 246.96, our stop, versus our potential entrance at 273.71 means we're risking 26.75 a share. And we are comfortable with no more than $1,000 of loss. We cannot own more than 37 shares. Okay. And if I did do 37 shares at 273, it'd be right at $10,100. So we're going to come under that. All right. And this might not work for all of you. This is going to work for me. We're going to go with just a nice clean 25 shares instead of 30. Okay. So that's the thought process there. I hope you all saw that. Again, what we've done is following our math on the left in my scratch pad. So 1, the position size in collection in total cannot exceed $10,000. Number 2, it also, with the stop level calculation included, we should not risk more than $1,000. So in this scenario, if we buy 25 at our stop of 273.71 and we lose the eventual 26.75 a share, we end up losing about $670. Nobody wants to lose that, but it is within our tolerance for risk and it is within our plan for this account. And that is precisely why we are going to go ahead and have comfort in placing this trade. So again, this is a buy stop. We got to break 273.71 to the upside to be a buyer. But once we buy it, then we've got that limit to sell 20 points above us at around 295 or at the stop of 246.96 as a sell stop thereafter. And there we go. So we're ready to go for tomorrow. In the last minute, hey, I just wanted to highlight a couple more things here. Just check this out. V also moving interestingly. There's a number of charts in this space that are starting to work. Gilead, also interesting as well, right? Recent move here, just today's or this week's action. Look at this, just took out former resistance right there. So this could have easily been one of the example trades as well. 50-day moving average violated and held, right? So this maybe it's an ATR below the 50-day for some traders there. Put your exit strategy in the ballpark of 126.5, which means you would actually have to violate these lows that come in around 127.5 to get taken out. So, you know, that's another one that's already appearing to show signs of improvement. And you notice here, you've got a pretty nice downtrend line breakout, and then the hold of the 50-day for a period of about 5 weeks or so before it broke out again. That chart really intrigued me when pulling that one up there today. So that one and AbbVie both kind of caught my eye as well. And I thought I'd just highlight those charts for all of you. So we'll wrap it up there today, everyone. As always, love hearing from you. Love having you participate in the chat. Thank you so much. For those of you who are new, hey, let us know how we did. You can reach me on X. That's the easiest place to find us when we're not hosting these classes. If you're catching this, however, in the archive, don't forget down below you can place questions. Any questions you submit in the archive as you're reviewing these on your own time, those come to us coaches directly as well, and we can reply to you there. So you've got 2 ways to engage with us, either on X or even LinkedIn, but here in the notes following the class in the archive is another way as well. So follow Connie and me on X, Connie Hill CS, Kevin Horner CS, subscribe to the channel as well, and hit that thumbs up for us down below. We're going to get this reviewed and available into the archive as quickly thereafter as we can, probably by tomorrow morning, most likely. And for those of you looking for more, don't forget, we've got the virtual workshops running this evening. Hit the calendar for that as well. Ben Watson, Ray Kimbrell, and Scott Durfee taking you through the paces on the virtual workshop event this evening and the rest of the week as well. So with that, thanks to Connie. Thanks to all of you. Have a great rest of your Tuesday. I look forward to catching up with you all again real soon.